Will I get a tax loss when I exercise my stock options that are underwater? The answer to that question is pretty contrary to what you might expect. So let me show you exactly what happens by first pulling up my whiteboard right here. So this represents an $8 exercise price, meaning in order to purchase your stock, you have to pay $8 to purchase a share. And this is going to equate to your tax basis. So anything above this line is typically going to be a gain. Anything beneath this line is typically going to be a loss. But this is where things might get a little tricky. Let's say that your price were up here, or the fair market value were at $15, fair market value. The spread between these $8 right here and $15, that spread has tax consequences to it. And depending on the type of option, if it's non-qualified stock option, it's going to be reported as a gain that's taxed at ordinary income. In the case of incentive stock options, that's also going to be considered a gain, but rather than ordinary income, it's going to be considered a bargain element for AMT. So again, there's a tax consequence here when you have a gain, but let's go to the opposite side of the spectrum and say that your stock were down here and it were less than the price that you paid for it. So you exercise at $8, and now when you exercise, the fair market value is going to be, let's say, $3, fair market value. And to be clear here, we're only talking about exercising. We're not talking about selling yet. We'll get to that in a second, but just exercising. So you might think just because when you exercised, when the fair market value is up here, you have to report the taxes. You might think that when you exercise and it's underwater that you have another tax consequence here and potentially a tax loss. But it actually doesn't work out like that. You don't actually get to write off this loss unless you are selling. So let me state that again. If you are exercising at a loss, meaning you paid $8 at exercise, but the fair market value is down here, you don't get to write off that loss. But if you are selling down here, then you do get to write that loss off on your tax form. So let me go ahead and show you exactly how that works. But before I get to that, I want to just note one quick thing that is probably most important out of everything that I'm going to be talking about today. This video is for educational purposes only. It is not intended to be specific or individualized tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your legal, tax, or investment advisor. I'm just going to say that you have a $1 loss. You paid $1 for a share. It's now worth $0. So you have that $1 loss, and you might think that, oh, because I get to write it off to offset some income, then I get to use that dollar to write off $1 of tax. Well, let me explain this a little bit because it doesn't actually work out like that. So on the tax form, you actually net, let's say short-term capital gains and short-term capital losses. You actually net those together on Form 8949 that flows through Schedule D, and then it ultimately ends up on your Form 1040. So you have this $1 gain that you can now write off. You say, hey, you know what? I'm going to take this $1 loss, and I am going to write off that $1 gain. So I no longer have to report that gain to the government. Well, you do have to report it, but it's not going to be taxed. So you might be thinking, oh, I just saved $1 worth of tax. And the answer to that is not exactly, because that $1 wasn't what your tax bill was. That $1 is what was reported as income. If you weren't writing that $1 off, it would have gone through the tax bracket, and I just used the highest current tax rate right now, which is 37%. So that $1 would have equated to 37 cents of tax due. And this is an oversimplification. There's a lot more that goes into this equation, but I'm just simplifying it so you can understand that $1 loss doesn't mean $1 in tax savings. It actually equates to savings in whatever tax bracket you're in. So whether that's the 12%, the 24% tax bracket, the 37%, actually equates to just saving 37%. So if your stock options are at or underwater or out of the money, doesn't make sense to exercise just so you can write off that loss, exercise and sell so you can write off that loss? The answer is probably not, because it doesn't equate dollar for dollar like a credit would. but instead it just saves you as much as your tax bracket is. So you paid $1 and you only got to save or disqualify, save 37% on your taxes. So is it worth it to pay $1 to save 37 cents? Not really. So because this can get more complex and each and every circumstance can be unique and very different, please work with your own professional to come to a conclusion on whether this is right or not for you. If you're interested in working with either me or my firm, you can start by scheduling an appointment down below in the description. Please check out my channel for more videos. Thank you.